My name is Walter Coles. I'm the president and CEO of Skeena Resources. I'm going to go through our presentation here. Our flagship project is Eskay Creek, which is a past producing mine that we are revitalizing. So why don't we jump right into the presentation. We're located in the northwestern portion of British Columbia, a famous region called the Golden Triangle. It's prolific for mineral discoveries. As mentioned, we've got the Eskay Creek project, but we also have the Snip project. These are both past producing underground mines that we optioned from Barrick, and we've since acquired them and own them 100%. We're also, I should mention, in the Tahltan Territory, and we are quite proud of our positive relationship with the Tahltan First Nation. One of the advantages of brownfield projects is the infrastructure that's already in place. We've got roads in and out of Eskay Creek. We can operate there 24/7, 365 days a year. Snip, we don't quite have a road all the way in, but pretty close. When these mines operated historically, they were powered by diesel and propane. Now we have this wonderful advantage of 3 new hydroelectric facilities that were built in the last 8 years between our 2 projects. So it's definitely a game changer from a cost perspective. I'm told that in certain years, Eskay Creek energy cost represented almost 50% of operating cost. Now with cheap, clean hydropower, energy should represent about 5% of our operating costs. So it's quite a dramatic change to the cost structure. Eskay Creek, when it operated, was a legendary mine. It produced 3 million ounces of gold and 160 million ounces of silver. The grade was an astounding 2.5 ounces per ton gold equivalent. Because of the much lower gold prices back in the time period where this mine operated, between 94 and 2008, that low gold price meant that the operators had to use very high cutoff grades. And again, keep in mind, they were powered by diesel and propane. So high operating costs, low gold, silver selling prices led to very high cutoff grades. In the first 4 years of mining, the cutoff grade was 1 ounce per ton. And once the mill was built, the cutoff grades dropped to around 15 grams per ton. Our twist in looking at this project today was to come in and evaluate it as an open pit mine, where we're able to drop that cutoff grade down to a gram. And we have the benefit of cheap energy, much higher gold and silver prices, and looking at this as an open pit, which led to this phenomenal resource that you're going to see on the next slide. There you go. We've got 5.6 million ounces in the measured, indicated, and inferred categories. In the M&I, we've got 5.3 million ounces, and the inferred represents just a small portion of the overall resource at 300,000 ounces. I should also add that the majority of this resource is open pitable. A very small amount of underground resource. It's just over 200,000 ounces of the 5.6 that we can't mine via open pit. The other thing worth mentioning is the grade. We've got an average grade here of about 4.2 grams per ton, which is not something you find very often for open pit projects. Typical open pit project might have like a gram and a half. So at 4 grams, that leads to incredible profitability and also margin of safety if we end up with a lower gold price at some point in the mine life. We published a PEA back in late 2019. Very robust. At the time, we used a $1,325 gold price as our base case. I think for our next iteration of this, the PFS will be using $1,500 gold price. But you can look at this project here at $1,500 gold, $20 silver. The after-tax NPV is $924 million Canadian. The after-tax IRR was 65%. The payback period was less than 1 year. On a CapEx of $233 million US, and an annual production profile of about 300,000 ounces a year. So a super phenomenal PEA that we put out 2 years ago. And we should have the pre-feasibility study out here in, we're thinking July of 2021 on the pre-fees. Pre-fees will show an increase in CapEx, but it will also show a significant bump up in the production profile. And we should see an increase in that after-tax NPV as well. So keep your eyes out for that. It should be an exciting milestone for the company. And here's just the layout of the mine design. Again, it was an underground historically. Now it will be an open pit. You can see, just the overall layout where the waste dump will go. We've also have the huge advantage of a fully permitted tailings facility and the former waste dump, Albino Lake. So what are the two advantages here? Well, when we think about that waste dump, remember they were using a 15-gram cutoff grade. So our view is there's probably material in Albino Lake that we can reprocess. We put a drill rig on the water or on the ice back in February, March and drilled this, and we should have drill results out shortly, and I think they might be pretty exciting. Switching over to that permitted tailings facility, we call that Mckay Lake. That's where all of the tailings went historically, and we're basically going to be using the same location to place our tailings. Again, the advantage is this site, this tailings facility is fully permitted with ample capacity for the tailings that will be created from this current operation. And why is that so significant? Because it typically, for permitting a new project, the tailings facility is the hardest thing to get permitted. So we've already got one that's ready to go, which means we're going to be able to get this mine back into production faster than we would otherwise. This just gives you a sort of long section look at what the open pit looks like. We've got one very large pit on the left side, and on the right side, you see a smaller pit that we call the 22 zone. The strip ratio might look kind of high, especially down in that NEX zone, but you got to keep in context that this is a 4 gram per ton deposit. So, you know, even if we have a strip ratio of 8 or 9 tons to 1 ton of ore, it's easily managed given the profitability of this project. If you think about it, in that a gram of gold, you know, it's probably worth around $60 US, $65 US. So multiply that times 4. So you're getting something in the range of, you know, $220, $240 of potential revenue per ton before mining dilution, versus our mining cost to move a ton of rock is around $3.50 Canadian. So call it even $3 US. $3 US times 9 to 1 or 8 to 1 strip ratio is anywhere from $24 to $27 in mining costs for that high strip, versus a revenue of over $200 a ton. So we can easily handle that high strip ratio shown on the left side of this screen. We're also drilling around the proposed pit. We think there's opportunities to expand the pit, bring in more resources, continue to grow the size of this project. Our previous resource was 4 million ounces. With the most recent resource update, we grew that from 4 million to 5.6 million ounces. I have a goal for our management team. Let's grow this from 5.6 to 7 million ounces, and near mine opportunities are one of the best ways we're going to be able to do that. Yeah, we've had some good hits. You see one of them right there in the lower mudstone layers. This is a stacked VMS deposit. So that's another opportunity further out in the mine life, is adding an underground component. So right now, Eskay, based on the PEA, ranks about the 5th biggest open pit project in Canada, with 300,000 ounces a year. But I mentioned to you that you're going to see a bump up in that as we move from the PEA to the pre-feas and the feasibility. I think with every one of those studies, you'll see an increase in production profile. And I suspect we'll end up over there somewhere between Detour Lake and Meliadine as the 3rd largest gold mine in Canada. Again, the truly unique thing besides size for Eskay is grade. You can see the average open pit grades are about 1.5 grams, and Eskay is running over 4 grams. So not only does it have size, it has exceptional grade, which makes it truly a one-of-a-kind project. One of the other incredible things that comes as a consequence of high grade and access to cheap, clean hydropower is that Eskay Creek is likely to be one of the lowest greenhouse gas emitters of any open pit mine in the world. And you can see here's a chart where it shows you where the average open pit mine is producing about 3/4 of a ton of carbon dioxide per ounce of annual gold production. And you can see where Eskay is going to sit down on the far left there with 0.14 tons of carbon dioxide per ounce of production. So we're really proud of this, that this will be one of the, I guess I would call it one of the greenest mines in the world. And we all know that there's a lot more emphasis on ESG these days. And I think this project will be a tremendous example of that opportunity. In terms of timeline, we've got a pretty significant exploration program planned at Eskay this summer. starting next month. We'll drill 25,000 meters. We'll have the PFS study published in July. We'll continue to do infill and exploration throughout the fall. And we'll have that full feasibility study we're targeting in Q1 of next year. And we'll look to do project financing immediately after that and start construction hopefully in the summer of 2022. I mentioned that we're in Tahltan Territory. We're very proud of our relationship with the Tahltan. We were founding a company of the BC Regional Mining Alliance. That's a collaboration with a handful of exploration companies in the Golden Triangle, as well as the government and the Nisga'a and the Tahltan. So the creation of that alliance really helped us develop, I think, a friendship and a mutual trust with our Tahltan partners. And that's culminated in the Tahltan deciding to make a $5 million equity investment in Skeena. It's the first equity investment that they've ever made in a mining company. So we were really honored that they decided to do that. The other sort of unusual thing that we've done with the Tahltan is we took one of our sets of mineral tenures, a project called Spectrum, that was very close to a sacred mountain for the Tahltan called Mount Ziza. And we in collaboration with the government and the Tahltan turned that 3,500 hectares of land into a new nature conservancy. So it's I think it's an unusual thing for a mining company to turn over their mineral tenures and create a new preservation area. But for us, economic prosperity has to be shared with environmental stewardship, and these actions fit with the core values of our company. In terms of our capital structure, we've got about 240 million shares outstanding. Market cap's around 800 million. We've had pretty good share price performance over the last 12 months, but I think that as we continue to grow this project, the share price should also continue to reflect those the continued growth in the production profile and the resource. So lots of opportunity to for further upside in the share price. With that, thank you very much for your time.